Eric, it was great to have Matt on the show. Now, listeners, you're going to find the download link for the post-game trade of the week in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Matt's picture saying, looking for the downloads.
Patrick, with volatility elevated and the market environment feeling increasingly uncertain with all the conflict in Iran, it seems like a prudent time to consider protection. In previous episodes, you've structured some very effective hedge trades. So how would you approach hedging in this market backdrop?
Eric, listeners will remember that the last time we featured the S&P 500 caller back on episode 508 with Lakshman Achuthan, it worked exactly as intended. The short call that financed the hedge was never tested, and the structure has now expired. The reason we're revisiting the caller today is that the market conditions have shifted. Technicals are deteriorating, leadership is lacking, and we have geopolitical shocks driving oil higher alongside credit stresses emergent in the system, like we've seen around Blue Owl. In this environment, upside potential looks limited, and it's a critical time to consider an overlay that helps hedge and dampen downside volatility. So here's the structure. With the S&P 500 at 6880, we're looking at the April 16th, 2026 expiration, 43 days out. We're buying the 65.35 put strike, about 5% below spot, for $67, and we are selling the 7100 strike call, roughly 3% higher above spot, near the recent highs, for about $51. That gives us a net debit of $16. This sets the floor about 5% below current levels while capping upside roughly 3% higher. But the real point of the trade is as a volatility dampener. It structurally lowers portfolio drawdown risks and gives you the psychological staying power to hold through noisy tape instead of getting shaken out at the wrong time. In light of the market risks, upside is likely limited. This overlay strikes a smart balance, paying a small debit to hedge downside volatility while giving up only a modest portion of the potential upside.
That explanation worked for the pros, and for our retail listeners, Patrick's Monday webinar at Big Picture Trading will break down this week's Trade of the Week in detail, as always. And because of the market turmoil caused by the Iran conflict, I've asked Patrick to consider offering our MacroVoices listeners another free webinar focused specifically on options strategies for protecting portfolios in turbulent times. Stay tuned, and hopefully Patrick will announce something along those lines in next week's podcast.
All right, Eric, we got to dive into the equities. What are you thinking here?
Patrick, the usual playbook when a war breaks out is first you get a panic in the markets. Oh my God, sell everything. There's a war on, for God's sake. That usually lasts a week or so. Then there's a realization as calmer heads prevail. Oh, wait a minute. Wars are always inflationary, and they always lead to increased government spending. And there's a need to replace all of the spent munitions and rebuild all the stuff that gets blown up. Hey, wait a minute. Wars are usually good for the stock market, despite the fact that they're always bad for humanity. Then, once that realization hits everyone's collective consciousness, a rally begins that often takes the market back above the pre-war highs. Now, the reasons that this time might be different is that was the playbook for what happens when a war breaks out when the market was not already top-heavy and looking like it wanted to roll over with a looming private credit collapse and numerous other signs that a top could already be in. So if this turns out to be the start of a really big correction or bear market, I don't think it will have been because of the Iran conflict. Rather, the Iran conflict will have been the proximal trigger that unleashed something that was already set to happen anyway. Meanwhile, the possibility exists of a wartime rally that actually has the potential to extend what was probably an overstretched bull market to new all-time highs. So I can see this going either way. I don't pretend to be smart enough to know which way we go from here, but I am glad that I put on an S&P hedge the last time Patrick recommended it a few episodes ago, and which we revisited in this week's Trade of the Week.
All right, Eric, I just want to keep this technically simple. For the last month, we have spent the majority of the time below the 50-day moving average on both the S&P 500 and the Nasdaq and the Mag 7s. The primary trend has been distributive in its nature, but surprisingly, the technical levels continue to hold the support lines, particularly on the S&P. There's obviously the risk of systematic trading kicking in below 6,800, but that line has held very, very well up until now. Now we have heightened volatility. We have a top in the Kospi. There's all sorts of stress gauges occurring. Even the breadth of the market is deteriorating. The market is structurally vulnerable for a breakdown. But what is the counter to this? The counter to this is that everyone is starting to get pretty bearish, and very rarely do markets crash when everyone is expecting it. That's what the bulls have to hang on at this point is that a short side has just gotten too crowded, and some sort of counter trend rally can get this market out of the danger zone. Nonetheless, the way I'm keeping it super simple, if this market trips up below 6,800 on the downside of the S&P, it really can start a feedback loop of selling, hitting the bid on a lot of systematic selling that can overwhelm the flows and drive a much, much deeper correction. But if the bulls can keep it together and squeeze, there's so many people starting to move to the sideline that in itself could actually drive the counter bull move. So I'm looking at it very neutrally here. The 6,800 will accelerate things to the downside. And if the bulls can somehow manage to get this back above the 50-day moving average, neutralize this current sell cycle, the bulls could actually hold things together for another month or so past the March expiration. All right, Eric, let's move on to that US dollar.
Patrick, there can be no doubt that the surge above 99.5 on the Dixie was driven by the Iran conflict. It's important to understand the mechanics of how this works. A lot of people might say, oh, but wait a minute, the dollar is really changing its role in the global currency system, and maybe it's not the most intelligent safety trade after all. Look, that doesn't matter. In a situation like this, a lot of institutional finance is driven by written mandates that were written decades ago. They have to go to U.S. dollar treasuries as their safety trade, regardless of what the manager thinks about whether that's a good idea or a bad idea. So it comes as no surprise whatsoever that those mechanics have driven this or any other war conflict to lead to an upward surge in the dollar index. That, in turn, ignites a short squeeze, which I think is probably already underway because there was a lot of structural short interest in the dollar market. That, in turn, might trigger trend-following algos to start buying the dollar in size. So one thing leads to another, leads to another. This might have much farther to go to the upside, especially if those trend followers get into the game. But going back to the fundamentals, it's important to consider the evolving attitudes globally towards U.S. foreign policy. So is the Iran conflict really dollar bullish on a fundamental basis, or did it just trigger a whole bunch of counter-fundamental mechanical events that are going to lead to a squeeze and a trend-following move and eventually a blow-off that reverts into a downside correction and then maybe a new low to lower lows, resuming the primary downtrend which has been prevailing in the dollar for several months? Well, the answer to that rhetorical question probably depends on your politics or your geopolitics. So as investors, my advice to you is don't let your own feelings about whether the U.S. is doing the right thing or the wrong thing here guide your trading instinct on the U.S. dollar. The question to ask after the initial impulse is over is not how you feel about U.S. policy, but how do the central banks that are holding U.S. treasuries as their primary reserve asset feel about current U.S. foreign policy? And are they more likely to continue to divest away from dollar assets, or are they going to redouble their interest in U.S. treasuries because they see growing tension in the world? Obviously, that depends on the perspective of the policymakers, but I do think it's a different world than it was several years ago.
Well, look, we were talking about how critical that 98 level was on the dollar, and we saw a substantial breakdown in the euro that drove that dollar higher. The yen remains weak, the pound remains weak. So structurally, the dollar strengthening here seems to have room to come to the top of the trade range near the 100 handle on the upside. There are some divergent currencies like the Canadian dollar, which actually looks like it's bucking the trend on the upside. Maybe it's the wading up into resources that potentially is a tailwind there. But overall, the dollar has neutralized the sell cycle. Doesn't make me immediately bullish, but it certainly takes the imminent bear breakdown of the dollar completely off the table. And at minimum, we're back into like a trade range kind of currency that has resistance above, but is not in a primary downtrend. All right, Eric, we got to talk about this oil move.
Well, obviously, Iran is the driver of the big spike upward in oil prices. And as of late Wednesday, we had moved above 78 on WTI. I don't have a Brent print in front of me, although Brent is probably the more relevant geopolitical yardstick to follow here. We're moving to new higher highs in the course of the conflict, suggesting, this ain't over yet. And I definitely don't think that it's over. Of course, the market will eventually peak and come back down as this whole conflict dies down. But I'm not convinced that it's going to die down anytime soon. President Trump, of course, told us it should be over in maybe 3 weeks or so. Where did I hear that before? Oh, I know. It was President Bush in 2003 who said it would be over in just a matter of weeks. That turned into 20 years. Now, I don't think there's any reason to necessarily conclude this one's going to be 20 years, but I don't think it's going to be over in 3 weeks, and I think it's really just getting started. Time spreads are outperforming the flat price here. I'm already taking some profits, probably prematurely. Not yet on my Z6, Z7 spread, which I've talked about here on MacroVoices. I also had another tranche of J6, U6, just a summer tranche that was based on my pre-war expectation of an expansion of backwardation through the summer months. I already went well beyond my expected price targets for that trade, so I went ahead and took profits on that one. I'm holding on to my Z6, Z7 longs because I think it'll be a few months before they really start to peak out.
Well, Eric, we clearly got the war risk premium into the price of oil. But what is a little bit surprising is that we only managed to surge to the same levels where we were in May when the nuclear sites were hit. But back then, the Strait of Hormuz was nowhere near being closed down, and now we have that situation. Like I'm a little bit surprised that the oil prices actually didn't surge even higher. On the short term, this is now going to be a headline-driven number. It's very hard to technically observe that some sort of a technical level's got to be hit at this stage. At this moment, my speculation is that oil will structurally stay in bull trend until there's clarity that the strait will be reopened. And then maybe that will lead to that profit-taking cycle. But it's very hard to make any technical calls beyond that. All right, Eric, let's touch on gold.
Patrick, the recent strength in gold is obviously Iran-related, but something happened on Monday night between about Monday midnight Eastern Time and Tuesday 10 a.m. that was utterly bizarre and I think is very worth paying attention to. What was happening is bombs were dropping, oil was going straight up in reaction to escalating geopolitics, and gold went straight down at the exact same time that the bombs were falling. The gold down on geopolitical escalation was surprising. So I investigated with both Google and ChatGPT searches. What I learned is that the consensus view on this is actually pretty darn clear. It's because the dollar index is up significantly. Gold is priced in dollars, and that's the reason for gold going down. Now, as I read that, the first thought to come to my mind is, gosh, that's exactly what I would have said if I were some sell-side imbecile who has absolutely no clue what's really going on, but needed to make something up that sounded smart. First of all, oil is priced in dollars too, and that didn't stop oil from going up in reaction to rapidly increasing geopolitical escalation at the exact same time this was happening. The argument for the last time the Dixie was at this level, gold was at such and such a level, is entirely sensible, and it would make sense in terms of where the dust would ultimately settle. But gold dropping suddenly down $400 in less than 12 hours as the bombs were dropping, as oil was pushing to new cycle highs, just doesn't add up. The only explanation that I can come up with, and this is raw speculation at this point, I can't figure it out. I'm grasping for straws here. But the only explanation I could think of as to why that would be happening is that someone who has a lot of size to sell needed to sell into strength. So, in other words, they were using fundamental events that would normally be expected to be very positive for gold, and they were selling into that strength. Now, normally, as a trader, if you're trying to do that, you set a bunch of limit orders and you allow the market to come to you. So, you're supplying rather than consuming liquidity. Whoever was doing this, if that hypothesis of mine is correct, was willing to move the needle not just a little bit, but $400 to the downside in less than 12 hours. So they must have had a whole lot of size to move. I'm asking myself, okay, which central bank would have a motive here to reverse their gold buying plans into gold selling plans instead as a reaction to these geopolitical developments? I can't really think of why that would make sense. But the fact that gold was down $400 in less than 12 hours as bombs were falling, as oil was rocketing up to new highs, just doesn't add up in my mind. It makes me wonder what's going to happen to the price of gold when those bombs are not falling and oil is not spiking to new highs, but rather is starting to mean revert back to the downside. So yes, the explanation of, well, it's because of the Dixie being at a level, well, last time it was at that level, gold was below 5,000. It makes sense in terms of where it might eventually shake out, but it doesn't explain that price action that we saw Monday night into Tuesday morning. So I think this is an important open question. If anybody knows the answer that I'm missing, by all means, let us know on Twitter.
Well, Eric, I mean, obviously there are geopolitics in play on this, but I'm in a position at this stage to stick with a technical landscape in gold, which is essentially that after major blow-offs in the past, gold has spent at least 2 to 4 months in some sort of absorption consolidation where prices consolidate before they go bullish again. I overall think that the bull trend is very likely to continue in gold, but curbing my enthusiasm that it all happens here in the first quarter of the year. At this stage, these kind of short-term tests on the upside could lead to retesting of 50-day moving averages, and I'm going to reserve kind of the idea that we're going to 6,000 plus for later in the year. Well, finally, Eric, any thoughts here on uranium?
Well, the URA ETF retested its 50 and 100-day moving averages as support on a broad market dip, of course, as a result of the Iran news. It recovered nicely on Wednesday, but we're not out of the woods yet, and there's still an open question as to what happens next in terms of the broader market and the Iran conflict. As of recording time before the market opened in London on Thursday morning, we're still looking at a down candle on S&P futures, just barely below that support line at 68.65 is where the support line was. We're about 15 points below that as I'm recording. Are we headed back down to lower lows, or is the bottom already in? I really don't know what's coming next for the broad market, but I suspect that if we do get more broad market weakness, we'll probably see a deeper dip in uranium prices. If that happens, I say it's a buy the dip opportunity. At what level? Well, it depends on how far we go deeper on the broad market correction, and that's anybody's guess.
Well, uranium to me has been surprisingly quiet, but it certainly hasn't, in my opinion, done anything bearish. This fits a lot of the criteria of what would be a typical retracing correction, and I don't see any reason to deviate from that thesis. All right, Eric, what are your thoughts here on copper?
Patrick, I'm starting to pay more attention to copper here because we've been really nicely supported by the 55-day moving average, and all of a sudden it looks like maybe it's starting to be given up. We're only a little bit below it as I'm recording, but we dipped substantially below it a couple of days ago, and it looks like maybe we're headed down again. Of course, copper is nicknamed as Dr. Copper because it tends to be a predictor of where the broad economy is headed. If we're about to be thrown into some serious this correction as a result of the Iran conflict, or I shouldn't say as a result, if the Iran conflict has been the catalyst to bring us into an economic correction that was probably in the works anyway. Dr. Copper should be a good barometer to indicate that's coming, so I'm watching it carefully.
Well, Eric, interestingly to me, copper seems to have correlation directly with the precious metals. We sort of seen a blow off top in the same window, counter trend rally in the same point, and a little bit of profit taking here in the last few days. At this stage, I'll be watching very closely to see whether that correlation between them continues.
Patrick, before we wrap up this week's episode, let's hit that 10-year Treasury note chart.
We clearly had a bond rally underway as yields were coming down to some critical levels, but this has decisively bounced back in the last 3-4 days. It'll be very interesting to see whether or not these yields are simply retracing their previous decline, or whether, in fact, that was a major support line that was tested, and now we're, let's say, going back to the top end of the trade range. At this stage, this is a key level right along this 50-day moving average, and it'll be very interesting to see whether this just sits here in this retracement zone or not.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview and the Trade of the Week chart book we just discussed here in the post game, including a number of links to articles that we found interesting. You're going to find this link and so much more in this week's Research Roundup. So that does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we are always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main account on X at MacroVoices for all the most recent updates and releases. You can also follow Eric on X at Eric S. Townsend. That's Eric spelt with a K. You can also follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.